With home prices hitting new all-time highs, is the American dream over? Has the Fed finally figured out how to create inflation that it can't control? And despite heat waves, are there signs that the U.S. economy is starting to cool off? And with nearly $1 trillion in overnight repo loans, is there any cause for concern? Answer to those questions is more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. You probably have already noticed we're hanging outside the castle walls today, and I wanted to use this example for what's going on in the U.S. Treasury bond market. Because right now, or at least we saw it last night, yields sustainably on the 30-year broke below. They fell us right. They went down. Your arrows out here went down. There we go. Below 2.1, and now have their eyes set on 2. And that is both our key resistance levels. So 2.1 needed a break, and it was like a wall. Sellers were hammering the gas there, trying to keep yields from going below that. They did. The big wall is at 2.0. So I thought this would be a perfect example of what's going on in the bond market. But let's talk about what's going on in the housing market, because prices have hit new all-time highs. And young people in particular are worried that they're priced out, that they're never going to own a home. And they're worried about it as if this will never end. The prices will now never stop because inflation is here and it's not going away. And we know that wages aren't keeping up with that. Now, in a sense, this is how higher prices become deflationary. Because if you don't have enough expansion or growth in the money supply to support higher prices, then what happens? More money is allocated to those things that are expensive, like food and housing, and less money for discretionary spending, which then in turn leads to lower consumer prices. In the housing market, if prices get too high and there isn't enough money to support them, then you see buyers disappear. And that's what I want to show you today. So let's start out with the S&P Case-Shiller U.S. National Home Price Index. No surprise here. Even this is now all-time highs as home prices just seem to now never-ending spiral. And we're hearing things just like we did for the housing bubble crash, that prices will never stop going down. And this is just the way it's going to be. But is there something that it tells us that perhaps that isn't true? Well, one of the things we can look at is the MBA Purchase Index. This is a Mortgage Bankers Association, looks at purchase applications. So if you're buying a home or getting a new mortgage because you sold your home and you're moving, you're going to show up on this statistic here. Now, this is reported every week. So we have last week's data today. And if we go back to May, we're right in here. And what we can see is purchase applications are now below the lowest point in the pandemic, and there's no signs of them slowing down. They're continuing to head lower. So while we're seeing higher prices here, we can see from an application standpoint that those higher prices are unlikely to be substantiated over the long term because there aren't enough people buying homes and getting new applications. Now, of course, you could have the argument that, people are just paying for cash. Well, there's only so many cash buyers in the market, and eventually they get tapped out too. So keep in mind that applications, while not a perfect leading indicator, are an indicator that home prices are too high. Now, we also have sentiment data to look at, and here we've seen this chart before. Home buyer confidence down here somewhere in the toilet, lowest level since 1990, and you have home builder confidence way up here. So home builders are cranking out homes as fast as they can, while home buyers are saying we can't afford them. And so what happens when buyers reject higher prices because they can't afford them? Again, this comes back to not enough money growth to support higher prices. Eventually, prices have to come down. And that is one of the challenges that people don't understand. And we can go back to the great financial crisis where we saw the consumer price index shoot up. And everyone's like, okay, here's inflation. But again, at that time, there wasn't enough money growth to support it. And there isn't now. Because when you look at where is all this money growth coming from, it's from government transfers through stimulus and unemployment benefits. And the stimulus are gone, and the unemployment benefits are on their way out. Even worse, we know that at some point the moratorium on evictions is going to end. We also know that people are going to have to start repaying on their student loans again, and that's going to take away from money they have. So money they're either saving is going to have to go to pay those bills, or money they're spending on other things is going to have to get cut way back to pay on these bills as they come back. And all that tells you is when financial conditions are tight, which is the bond market is telling you, because when interest rates are low, when they're low, it tells you financial conditions are tight, and when interest rates are falling from a low point, it tells you they're getting tighter, and that is a sign that there isn't enough money growth, that monetary policy is actually too tight. So is the American dream over? Well, not exactly. So what is likely to happen is we will see at some point a correction in the housing market. Now, will it be a complete annihilation like we saw in the great financial crisis? Well, that's a good question, because right now we still have the baby boomers and we have the millennials, and there is a strong demand for housing when you have two large groups that need housing. But as the boomers get older, downsize, and move on from this world, well, they will shrink, and that will have a problem in the housing market, as we might actually have too much supply. So let's go take a look at some of the economic data and see if we can find evidence of what's going on with this economy cooling off and the Fed fighting inflation. One question that's come up, and I addressed it on a previous show, but it's worth addressing again, is here on Monday, the 3 and 6 month Treasury bill auctions were at 5 basis points and 5.5. Now, people are asking is, there have been some of these bill auctions, these short-term bill auctions below 5 basis points, which is the same the Fed is paying on its overnight repo loans, which we'll talk about. We'll talk about again in a little bit. Why would anybody pay less than 5 basis points when they can go get it over here from the Fed for 5? The answer is real simple if you think about it. Has the Fed promised or made any indication that it will run this reverse repo operation, these overnight loans at 5 basis points indefinitely? Nope. So the fact is the Fed could stop them at any time, still leaving a collateral shortage, meaning if you need collateral, you still will pay any price to get it, knowing that the Fed could change their policy tomorrow. All right, let's continue on the economic data and see what interesting things we can find, because there's certainly some stories of disinflation in here, and let's see what we can find. So let's go into Tuesday, where we'll head over to Spain, take a little bit visit there. Month over month, the preliminary CBI is predicting to come in at 0.4 from 0.5 the month before. So it's slowing down. That's disinflationary. Let's go on to the Eurozone and see if we can find anything interesting here. Sentiment is up. Industrial sentiment, services sentiment, that's good. Consumer inflation expectations are up, but consumer confidence is unchanged in June. It's a little bit different than here in the United States, where we saw that number go up. Let's continue on and over and visit Germany now, where we see a further story of disinflation in the preliminary CBI numbers going from 0.5 to 0.4. So we're starting to see evidence of the European economy cooling off, but we'll still talk about the U.S. economy here in a bit. How about those housing prices? There you have month over month of 1.8%, year over year 15.7%. Again, we know driving all-time highs as the S&P Case-Shiller indices also up and up some more. How about Conference Board's consumer confidence? So here in the U.S., the June data, consumers are oddly more confident. Now, I will tell you that this makes no sense to me, because you'd think without the stimulus, and you'd think without, with unemployment benefits starting to go away early for some states, that you think consumer confidence would head lower. But apparently consumers are more confident. We'll see how long that lasts. Maybe they're just hopeful that the economy will turn around and be what it needs to be, what we're promised it is going to be. How about we head over to South Korea? We find out that industrial production missed expectations of a 0.8% increase in May and actually fell 0.7%. Not really a positive sign, since South Korea is an exporting nation. Services sector output went from plus 0.2 to minus 0.2. And then we'll slide over to Japan, and we find preliminary month-over-month industrial production data for May missed expectations and hit minus 5.9 instead of minus 2.4 as expected. That's not good, but they're also pretty optimistic. They think the June numbers will be way up, but the July numbers won't. But they completely missed the May, so we'll see how they do. And now we'll just head a little bit west over to China, And we see further evidence of the global economy slowing down. How about the manufacturing? This is PMI, Purchasing Managers Index. In June, this is a diffusion index measuring the change from the prior month. Prior month was 51, now it's 50.9, so virtually unchanged, but showing almost a negligible expansion in the Chinese manufacturing sector. How about the non-manufacturing or services PMI, 55.2 down to 53.5, so indicating that the services sector in China is growing at a slower rate than the month before, barely growing at all. At 53.5 is hardly anything. At 50.9 is virtually nothing. Let's move on to Wednesday, today, and what do we see we'll head over to France. And how about the preliminary month-over-month CPI? 0.3 last month, 0.2 this month. Disinflationary data there in France. And we'll head down to the producer price index in Italy. So we'll take a little trip south. And producer prices there are also disinflationary month over month from 1.3 to 1, but 1 is still pretty decently strong number. So producer prices still headed higher in Italy, but not as fast. But inflation, well, Italians not feeling that either. Preliminary CPI data has dropped from 0.4 to 0.1 disinflationary print there. But the broad Eurozone giving us a little bit different picture. The CPI month-over-month preliminary coming in, predicted to come in the same at 0.3 as it was the prior month. And how about core? Remember, core strips out food and energy. Preliminary data up slightly from 0.2 to 0.3. So not seeing this in the countries we just looked at, but apparently the broad Eurozone seeing just a tiny bit of inflation. And now we'll move into the mortgage applications. And this is something that a lot of people don't look at, but it's one thing I do. And you see the applications week over week drop 6.9%. So showing demand for not only new mortgages as we looked at, but refinances are falling. And since a lot of people use their houses, their equity as an ATM to purchase other things, that refinance is falling is not a good sign in the U.S. So let's take a look at the ADP non-farm payroll report. And so let's find out, is the U.S. economy cooling off? Well, we know the mortgage applications are definitely indicating that there's a slowdown there. But how about the ADP? Well, let's take a look at what's going on with that report. Up 692,000. So that's great. That's a good number. In normal times, that is a phenomenal number. But right now, that may not be as great as it looks. We see the employment was broad-based, small, mid, and large businesses all higher. And not surprisingly, the good producing sectors wasn't up much, but look at the services sector, 624,000 jobs. And as you probably can guess, most of it was in leisure and hospitality, followed by education and health. So a lot of jobs created there, which makes perfect sense as the economy is as the U.S. economy is reopening. We expect that a lot of the jobs lost in leisure and hospitality should be the ones regained. But is that number that great? Well, not so much, because last month it came in at 886 and now we're down to 692. So coming out of the pandemic into the reopening, you would want to expect this curve to go higher and higher and higher and then plateau and come back down to normal levels. If May is the peak, then it is definitely an indicator the U.S. economy is indeed slowing down. What else do we have? The Chicago PMI, remember the Purchasing Managers Index, this is diffusion, so month-over-month change went from a very hot 75.2 down to 66.1. What it tells you is things are still expanding. They're just not expanding at nearly as fast a rate. And when you see these PMI reports start to peak, that's where you get peaks in the equity market. Let's head over to Chicago and see what the data here, because there's some interesting things in this report. And let's see, it fell to 66.1 in June, a 4-month low, so we kind of know that. Among the 5 main indicators, order backlogs saw the largest decline. Now, when you think about order backlogs, this is important because where you get inflation is from order backlogs. And this makes sense because if you have a business and your order backlogs are piling up, well, what does that tell you can do with your prices? Well, it tells you the prices now become bullish and you can raise them because you've got a huge backlog of orders. So the fact that order backlogs are starting to fall is not a good sign of sustainable inflation. Supplier deliveries or posting the only gain. So new orders languish markedly. That's not good either. So you would want to expect to see new orders continue to drive up and backlogs as factories cannot produce fast enough. So new orders dropped to a 3-month low in June. However, the index went up. That's weird. Order backlogs slowed. We already talked about that. Inventories decline. Now, that's not necessarily good either. You normally want to, you do want to see inventories declining with order backlogs going up and new orders going up. But if you're not seeing demand, well, then this could be a problem. And from an employment perspective, is the lowest level since January, with firms noting difficulty in finding new staff. Well, they always note that. That's not nothing new. But the fact that you're not seeing hiring, well, that's a problem. And prices paid surged to the highest level, suggesting, as we pointed out, that consumers are rejecting higher prices. And again, that's what happens when you don't have enough money growth and you have these big bouts of inflation. It's how you know this is going to be rejected. All right, let's head back and see if we can find out. We'll come back to the Fed data here in a second. Pending home sales up 8% after being down several months in a row. Expect this to be a one-off report. How do you know? Because the mortgage application data is telling you that there isn't a lot of buyers left out there, at least based on the flow of new applications. Crude oil saw a nice drop, 6.7 million barrels, and normally should be bullish, and crude oil went up and then got rejected after that. Gasoline inventories up 1.5 million barrels. Not unusual. We're still well within range of where they should be. Distillates, this is your diesel fuel, jet fuel, down about 869,000 barrels. So can the Fed find inflation? Well, the answer is no. You have to think about inflation as a monetary phenomenon because that's what everyone thinks. They go back to Milton Friedman and say, oh, the Fed can create inflation when that's not the case. The Fed is really trying to figure out if we have sustainable inflation. And what is sustainable inflation? Well, it's a broad increase in goods and services. So if you remember, if you were young enough to be around in the 70s and early 80s, I was pretty young at the time, but I do remember some things, a few things. What you find is inflation is broad-based. It doesn't matter if you're going to the grocery store or out to eat or on vacation or just at home. Everything's rising in price, and so too are wages. And employers are then forced to increase wages because they need their employees to be able to pay for things. So what are we seeing right now? Well, we've looked at the Atlanta Fed wage tracker and see that wage growth is slowing down. And now let's take a look at what the Fed is looking at. Now, they're probably, the FOMC is not focused on this report, but I'll tell you they certainly are looking at this. And this is the Dallas Fed trimmed mean PCE inflation rate. And what they do is they trim off the highs and the lows and take the belly of price changes. And what we see, let's take a look at this. The headline, or all items PCE price index rose an annualized 5.5% in May after increasing at an annualized 8% in April. So it slowed down, but it's still very, very high. And the excluding food and energy, the core PCE rose at 5.9% and then 8.7% the month before. So again, it was slowing, but slowing at a very, very high pace. Now, if you take the Dallas Fed's trim mean PCE inflation rate, so you strip out the highs and the lows and get the belly of inflation, it grew 2.8% in May compared to 2.4% in April. So what you're seeing from the Dallas Fed, which the FOMC does take this into consideration, is you're seeing some outliers on one end driving prices up, and you're seeing some things on the other end driving prices down. But the belly of price increases, they're not that much. And that's how the Fed knows that inflation is transitory. All right, let's talk about this repo thing because we mentioned, last week or week before that I expected this thing to break $1 trillion at some point. Well, we didn't quite get there, but let's take a look at what's going on here. Repo loans, as you can see, $991.939 billion. So just shy of $1 trillion as banks and other institutions are allowed to participate. So you see participating counterparties, 90, accepted counterparties, 90. I mean, you see that they took everything in, almost $1 trillion in overnight, and yet it had no influence on the market. But we do know from the bond market's perspective, which we've looked at this before, and it's worth revisiting because people don't really understand. They think there's nothing going on here, and there are some things that are pretty dangerous. And what we see is when overnight repo goes up, it tells you there's a collateral shortage. And all that means is, if you haven't if you're new to the show or you don't understand what's going on, is if you look at the issuance of T-bills, T-notes, and T-bonds, which are collateral to the banking system, and what the banks want, there isn't enough of the right ones out there. And this is a problem because as we go into the budget, the Congress has to pass a new budget. Well, they're drawing down the TGA, and the longer they draw out signing a new budget, well, you don't have any new issuance of Treasury securities. And so every month, what the U.S. Treasury normally does is it takes short-term debt and it refis it down the curve. And then we have the Fed doing quantitative easing where it's buying up seemingly all of the dealer takes. So it's reducing the supply. So what's happening is the longer this budget issue gets drawn out, the deeper the collateral shortage will get. Now, will it cause any problems? Well, it will bring interest rates down, and we can see that here. As repo goes up, as the collateral shortage gets worse, interest rates go down. As it kind of settles down, interest rates start going back up. And then as it starts, collateral shortage goes up, interest rates head back down. As it finally settles in, interest rates start to rise, but they run into another collateral shortage. This was the Trump elections, and so everyone got excited about inflation, collateral shortage, and then that was like, nah, not so much. The collateral shortage turned into lower rates, and then finally as the collateral shortage went away, interest rates were able to go up, and before they got too high, headed lower. Here's another collateral shortage, went to lower rates. Here you see collateral shortage, rates headed lower, telling you what the bond market always tells you in these situations is that when interest rates go down, well, crown's not very visible under this scenario. When interest rates go down, financial conditions are tightening. And when yields break 2% on the 30-year, they'll make a quick move to 1.8. And if you watch the Sunday Night Chart Show, you're familiar with this. We talk about this. And at 1.8, I'll share with you when the time comes what interesting things happen there. I'm Steve Van Metre. Thanks for watching. We'll see you back on Friday for the Macro Show. As always, thanks for the likes, thanks for the subscribes, and thank you, because if it wasn't for you, we wouldn't be doing this show. Till Friday. Bye now. The content of this video provides educational information only. It's not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by a security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advice, Inc. or Steven Van Metre Financial.